As you look at this risk in particular, when it comes to geopolitics, how do you play it, and how has it been played so far, maybe or maybe not been overdone?
Well, I think that there was certainly risk premium being priced into Russian assets like the ruble and MSCI Russia stock index, for example, that we follow from, say, mid-December until late January. And then both of those markets have rallied significantly as people, kind of faded the whole Russian risk premium move, right, and bought rubles back for yield and stuff like that. And if you look at other assets like Euro Poland, where the Polish zloty's actually been appreciating against the euro, it did sell off a little on Friday late afternoon when it was untradeable, and a little yesterday, but it's rallying right back to new highs against the euro. So I don't think there's huge evidence that a massive amount of risk premiums been priced into Russian assets. We can point to a few assets that have been, have gone up significantly, like palladium since mid-December. They're off today a little, but, and you might think that that's evidence of a risk premium. But I think in general, in markets until a few days ago, most investors had a very low weight priced on the chance of an actual Russian incursion, major incursion into Ukraine.
So 6 weeks ago, not many investors had really factored in the idea that the Fed was going to be aggressively raising interest rates. The last 6 weeks have seen, obviously, significant repositioning around that. It's a quantifiable risk, but talk to me about how your thinking has evolved.
Well, I think, we're seeing what we anticipated, but which you can't necessarily position for, completely in advance, which is that we're finally starting to see the Fed realize, that the labor market is too hot. They're going to have to raise rates, more than, they're not going to raise rates 3 times the market's pricing, more like 6. But so far, all the market has done is move the rate hikes forward. They really haven't raised the total number of hikes at all, hardly. So it's kind of odd. And we're seeing the same thing around the world in various markets. People think that as soon as there's a lot of bond traders, for example, think as soon as the Fed gets rates to 175, there'll be a recession and the Fed will immediately backtrack. We have a different view of it. If you look at inflation, it started to really move higher last spring, not only because of base effects, but on higher frequency basis, it went up. And that was as U.S. unemployment dropped below, 7% and through 6%, right? We're now at 4%. We're probably going towards the low 3s. That acceleration in inflation as unemployment dropped below 6 or 6.5 might indicate that the non-inflationary rate of unemployment is more like 6 or 6.5. And that means that we're going to have an incredibly tight labor market, and the Fed is going to have to hike rates far more than the market's pricing in still.
Okay, so maybe the terminal rate is going to be higher than anticipated, but let's just talk about liftoff first. Citi out publishing after PPI saying 50 basis points is going to have to be the move. Do you agree with that?
I think the Fed has a short period of time before the blackout period to really, really hit back against that. We've seen a few Fed officials push back a little on it, but not very hard. And the major people haven't pushed back against it. So unless they start a concerted campaign to push back very hard against it and push back market expectations, they are going to be boxed into going 50. And I think the political situation in the U.S. has also changed dramatically, where there's now political pressure on the Fed to actually start to do something. So I think they're going to go 50, and then they might even do another 50 after that. But they're going to go in March, May, and June, and I think they're going to go 50 in March, unless we see, Governor Waller and other people coming out really aggressively against it.
Said, what I think is interesting about what you just said is not the first 50, but the second 50. And the danger, presumably from a Fed's point of view, is that they go 50, the market will then extrapolate in bigger increments. Is that likely, do you think, to happen?
Well, I think if they go 50, right, there'll be people who'll start to price more than 25 for May as well. And then it'll depend on the data. But so far, the Fed's been dead wrong on inflation. They've waited a year longer than they should have to end bond buying. They're still buying bonds today. They can't explain why. And they haven't done any hikes at all yet. So, they're really far behind the curve. The correct thing to do is, if you think your rate should be today already, at like 1.5%, maybe they should just hike to 1.5 right away, but they're never going to do that. But,
Yeah.
I think the market is going to start pushing them, and the dollar has not been acting very well. The dollar has, been weakening against a lot of other currencies. So it also indicates, I think, that the Fed really needs to get rates higher faster, in my opinion.
And if they move aggressively, how ugly could it get for credit, Said?
Well, my guess is that so credit spreads are tight, whether you're looking around the world, whether you're looking US or Europe. A lot of that has to do with the massive amount of QE that's pushed down yields around the world and forced people into credit assets, right? So credit could definitely widen. There's companies that have been getting refinanced who, in a normal credit market, probably couldn't get refinancing. And some of those companies may have more difficulty getting financing eventually as well, which means eventually you're going to see default rates also rise a little.
A little. Sorry, are we just going to get defaults
Moderately,
rising a little, or are we going to get a proper credit cycle here?
Let's say I think that they have room to widen, but how much wider or how aggressively, that's difficult to say. The thing you have to keep in mind is that the Fed hikes rates, let's say this year, by the end of this year, to 1.5%. Okay. I still think that's a very accommodative Fed funds rate, given we have inflation above 7%. And so that means that it's not like we're slowing the economy down. We're just starting to, maybe we're going to keep it from, growing at a crazy rate, but we're not like putting into recession, I don't think, by putting rates up to 1.5%. I think we have to get rates up, into a restrictive territory eventually, because we're going to have to get unemployment higher. And given how low unemployment is going to get here, it's going to be difficult to avoid a recession ultimately. But the recession isn't going to happen this year unless the Fed does a much more aggressive hiking cycle than I think they will. It's probably won't be for a couple more years based on the way the Fed's talking. So, it all depends on how much they hike. But I think the Fed's going to have to get rates up, a lot more than the market prices. And then eventually you will get a softening economy and a recession. So the credit cycle, you don't want to be too early, too aggressively. I mean, you might want to be betting on credit widening here and mortgage and MBS widening as well, but because the Fed may start active sales of MBS at some point. But I don't think you want to, go all in yet.